Welcome to our deep dive today into the world of long-term stock investing.
Yeah.
We're going to be exploring insights and data spanning like nearly a century,
Wow.
from historical market trends to expert opinions and real-world examples.
Okay.
We've got a really fascinating mix of sources to unpack, and our mission is to help you understand
Yeah.
the potential and, yeah, the pitfalls, too, of staying invested in stocks for the long haul.
You know what's especially interesting to me is that
Yeah.
we often hear about these incredible long-term returns
Mm-hmm.
of the stock market,
Mm-hmm.
but we rarely kind of delve into the why behind those returns.
Right.
And so that's what we're going to be doing today is to really provide you with a deeper understanding
Yeah,
so you can make more informed decisions.
exactly. And it's not just about understanding the numbers, but
Right.
also the historical context and,
Mm-hmm.
and the human psychology that can drive those numbers.
For sure.
For instance, did you know that despite all the crashes and corrections,
Right?
the U.S. stock market has never lost money over a 20-year period?
It's a remarkable fact.
Yeah.
And, it might seem counterintuitive given the market's reputation for
Mhm.
volatility, but there are a few key factors that I think contribute to this
Uh,
long-term resilience.
okay.
Firstly, the U.S. economy has historically demonstrated a remarkable ability
Mm-hmm.
to innovate and adapt.
Right.
From the Industrial Revolution to the digital age, American companies have consistently been
Yeah.
at the forefront of technological advancements, creating new industries driving economic growth.
That makes sense. If companies are constantly innovating and growing,
Right.
their earnings should, in theory, follow suit, which should ultimately be reflected
Yes.
in the stock market's performance.
Exactly. And then secondly, the U.S. has a well-established and relatively stable political system,
Mm-hmm.
which provides a degree of certainty for businesses and investors.
Okay.
This stability can foster long-term investment and economic expansion.
So it's not just about the companies themselves, but
Right.
also the overall environment in which they operate. A stable and supportive system can make a big difference.
Absolutely. Now, before we get too far ahead, I think it's worth kind of rewinding a bit
Okay.
and exploring the evolution of how stocks have been perceived as investments.
Okay.
Back in the early 20th century,
Mm-hmm.
stocks were often viewed with skepticism,
Oh, I bet.
even by prominent figures in finance.
Yeah, I can imagine investing in stocks back then probably felt like a gamble,
For sure.
especially with limited information and wild market swings.
Precisely. There was a lot of debate, actually, about whether stocks were suitable
Okay.
for the average investor.
Interesting.
Some, like Lawrence Chamberlain, they saw them as pure speculation, not true investments.
Oh, wow.
But then researchers like Edgar Lawrence Smith emerged,
Okay.
challenging that view with groundbreaking work like the common stock theory of investment.
Interesting.
They demonstrated that despite short-term volatility, stocks could actually outperform bonds over the long run.
That's a pretty significant shift in thinking. It seems like Smith's work really laid the foundation for how we view long-term stock investing today.
Absolutely. And later, Jeremy Siegel,
Okay.
in his book Stocks for the Long Run,
Hmm.
built upon this foundation, making a compelling case for stocks as powerful engines
Yeah.
of long-term wealth creation.
Did he also acknowledge that the world has changed?
Yeah.
Globalization and other factors might impact future returns,
Yeah,
even if the long-term trend remains positive.
exactly. Siegel believes that globalization,
Okay.
while potentially leading to higher average price-to-earnings ratios,
Mm-hmm.
could also result in lower average returns
Okay.
going forward.
So it's not a guaranteed thing.
Right.
This highlights the importance of understanding not only the historical performance
Yeah,
of stocks, but also the evolving dynamics of the market.
absolutely.
Okay, so we've established that stocks have historically performed well
Right.
over the long term, but it's not a simple set it and forget it strategy. There are nuances and factors to consider, especially as the market landscape shifts.
Right. And one of the fundamental concepts that I think every investor should understand
Okay.
is how stock market returns actually work.
Okay.
And this brings us to the concept of discounted cash flows.
Okay.
This is the lifeblood of stock valuation.
Yeah, right.
The idea that a stock's price today
Mm-hmm.
reflects the present value of all the future cash flows
Mm-hmm.
that the company is expected to generate.
So for an investor like me,
Yeah,
understanding discounted cash flows helps me assess whether a stock's price truly reflects its future earning potential. It's like
yes,
trying to figure out if I'm getting a good deal on those future earnings.
precisely. But figuring out those future earnings can be tricky because
Yeah.
there are different ways to calculate them.
Sure.
You have GAAP earnings, which are the official audited numbers.
Okay.
And then you have non-GAAP earnings,
Mm-hmm.
which often exclude certain costs that companies argue don't reflect their ongoing performance.
It's like comparing a student's report card with and without extra credit.
Yeah,
Both offer insights, but you need to understand the context
right.
to interpret them properly.
That's a great analogy.
Things.
And this distinction becomes crucial when analyzing PE ratios,
Mm-hmm.
which are widely used to assess the relative value of stocks.
Right. The PE ratio is essentially the price you're paying for every dollar
Yes.
of a company's earnings. But as you pointed out,
Yeah,
which earnings are we talking about, GAAP or non-GAAP?
right.
And then there are factors like interest rates, inflation, and economic growth that can further complicate PE analysis.
Absolutely. High interest rates can make future earnings less valuable today,
Okay.
leading to lower PE ratios.
Interesting.
Inflation can distort earnings figures, making it hard to compare PE ratios
Okay.
across different time periods.
Gotcha.
And robust economic growth can boost earnings expectations,
Okay.
leading to higher PE ratios.
So understanding the interplay of these factors is crucial
Yes.
for making sense of PE ratios. Absolutely.
It seems like understanding stock market returns requires more
Right?
than just looking at a few simple numbers. There's
Yeah.
a whole ecosystem of factors at play.
That's exactly why we're doing this deep dive.
Yeah.
To equip you with the knowledge to see beyond the surface and make more informed decisions.
All right.
Now let's add another layer of complexity to the mix. Market volatility.
Oh, yes. The infamous market roller coaster.
Yes.
It's known for its wild swings, its boos and busts. I'm eager to hear what insights our sources have to offer on this topic.
What's fascinating here is that market volatility isn't just about random fluctuations.
Okay.
There are underlying factors, from market psychology and government actions to global events that can drive those dramatic swings.
Well, it's not just about the numbers themselves,
Right.
but also the stories behind those numbers.
Yeah.
The human emotions, the political decisions, the global shocks that can send the market into a frenzy.
Yes.
It's almost like the market has its own unique psychology.
Yeah.
Precisely to illustrate this point.
Okay.
Let's delve into some captivating historical examples.
Okay.
We'll revisit the 1929 crash, Black Monday in 1987, the aftermath of the 9/11 attacks, the 2008 financial crisis, and the more recent market roller coaster triggered by the COVID-19 pandemic.
Wow, that's a lot of market history to unpack. I'm ready to dive in.
Let's go. Each of those events offers, I think, valuable lessons about how the market reacts and often overreacts to unexpected news and changing conditions.
Yeah.
Take the 1929 crash, for instance.
Oh, yeah. That one's almost legendary for how drastically the market plummeted. I imagine it must have felt like the world was ending for investors at the time.
Absolutely. It was a period of widespread panic and financial devastation.
Yeah.
But it also underscored the importance of diversification
Okay.
and the dangers of speculation.
It's a reminder that even in a strong economy, risks exist, and understanding those risks is crucial for long-term investors.
Precisely. And as we move through history, examining events like Black Monday in 1987, the 9/11 attacks, and the 2008 financial crisis, we see these recurring patterns of fear and exuberance that drive market volatility.
So studying these historical patterns could potentially help investors like me make more informed decisions in the future.
Yes.
It's not about predicting the next crash,
Right.
but rather about recognizing the forces that can drive those market swings and maybe being a little better prepared mentally
Sure.
for those ups and downs.
You've hit the nail on the head. It's about building resilience and a long-term perspective.
Okay.
And speaking of strategies for navigating this volatile landscape,
Yes.
let's explore one of the classic approaches, value investing,
Okay.
championed by Benjamin Graham and David Dodd.
Value investing. It's all about finding those hidden gems, those undervalued companies that the market might be overlooking. I've always found that idea intriguing.
Yeah.
But how do you actually go about identifying a value stock?
Value investors rely on several metrics,
Okay.
but some of the most common include PE ratios, dividend yields, and price-to-book ratios.
Okay.
They look for companies with low PE ratios.
Relative to their earnings growth potential.
So a company with a low PE ratio might be undervalued compared to its future earnings prospects,
Exactly.
like finding a great deal on a promising stock.
Exactly. Value investors also look for high dividend yields, which suggest a steady stream of income for investors.
Okay.
And they pay attention to low price-to-book ratios,
Okay.
indicating that a company's assets might be valued cheaply by the market.
It's like being a bargain hunter in the stock market looking for those diamonds in the rough.
Right.
I've heard, though, that value investing has been out of favor in recent years.
Yeah.
What happened?
It's true that value stocks have underperformed in recent years,
Okay.
and there are a few possible explanations for this.
Okay.
One is the rise of technology companies,
Okay.
which often have high growth potential,
Yeah.
but also high valuations.
Right.
Another factor is the changing dynamics of the market,
Okay.
with trends like globalization and low interest rates potentially favoring growth stocks. But some argue that the digital economy has fundamentally changed the game.
Yeah.
Do traditional value metrics still hold up in a world dominated by intangible assets, like software and intellectual property?
That's a great question, and it's a subject of ongoing debate among investors.
Yeah.
Some believe that this underperformance of value stocks is temporary
Okay.
and that value investing will eventually make a comeback,
Okay.
pointing to historical cycles where value has gone in and out of favor.
So it's like a pendulum swinging back and forth between value and growth, with each style having its moment in the sun.
That's one way to look at it.
Mm.
Others, however, suggest that the market has fundamentally changed
Okay.
and that factors like technological innovation and intangible assets have diminished the effectiveness of traditional value metrics.
Okay.
They argue that we need to adapt our thinking about value in the digital age.
That's a really interesting perspective. It makes me wonder how we can even begin to measure the value of something,
Yeah,
like brand recognition or a loyal customer base in the digital world.
it's a challenge. And it's one of the reasons why factor investing has gained popularity in recent years.
Oh.
Factor investing moves beyond simply looking at market capitalization
Okay.
and instead focuses on specific characteristics or factors of companies that have historically been shown to drive returns.
So it's like looking under the hood of the market, trying to identify those specific traits that give certain companies an edge over others.
Exactly. Some key factors include size valuation, momentum, profitability, and liquidity.
Okay.
For example, remember the small firm effect we mentioned earlier?
Yeah.
The idea that smaller companies have historically tended to outperform larger companies over the long run.
Right.
That's a classic example of factor investing in action.
That makes me think of those nimble startups that disrupt entire industries. They often start small but have immense growth potential.
For sure.
Are there other examples of factors that have surprised researchers?
Absolutely. One interesting finding is that companies with high share buyback programs tend to outperform. This suggests that companies returning cash to shareholders through buybacks might be signaling confidence in their future prospects.
It's like they're putting their money where their mouth is, backing themselves to succeed. So factor investing is all about uncovering these hidden drivers of returns and then building a portfolio tilted towards those favorable factors.
You've got it. But it's important to remember that factor investing isn't about finding magical factors that guarantee success.
Right.
It's about understanding the risks and trade-offs associated with each factor
Okay.
and building a diversified portfolio that manages those risks effectively.
That makes sense. It's like building a well-rounded team with players who have different strengths and weaknesses. You want a mix of factors to create a resilient portfolio.
This all makes me think about the human element of investing.
Yeah.
We've been talking a lot about numbers and strategies,
Right.
but at the end of the day, it's people making those investment decisions. And people aren't always perfectly rational, are we?
That's where behavioral finance enters the picture.
This fascinating field explores how our psychological biases can influence investment decisions,
Right.
often leading to irrational market behavior.
I'm really curious to dive into this. What are some of the common biases that can trip up even the savviest investors?
There are many, but let's start with overconfidence,
Okay.
a common pitfall for investors.
Okay.
It's that tendency to overestimate our abilities and the accuracy of our predictions,
Right.
which can lead to excessive trading and risky bets.
I've definitely been guilty of that myself. I'm sure we've all had those moments where we thought we knew more than we did, especially when it comes to investing.
Another common bias is loss aversion.
Okay.
The pain of a loss is felt more intensely than the pleasure of an equivalent gain.
Oh, yeah.
This can lead investors to hold on to losing investments for far too long,
Yeah.
hoping to avoid realizing that loss,
Right.
even if it means missing out on better opportunities.
It's like the old saying, throwing good money after bad. It's often the smarter move to cut your losses, but emotionally it can be tough to do.
Absolutely. And then there's the herd mentality or information cascades, where investors pile into popular trades simply because everyone else is doing it,
Right.
regardless of the underlying fundamentals.
Right.
This can lead to asset bubbles that inflate far beyond reasonable levels.
Okay.
The technology bubble of 1999-2001
Right.
is a classic example of how herd behavior can drive prices to unsustainable heights.
That was quite a ride, and not one many investors would want to repeat. I remember hearing stories of people pouring their life savings into tech stocks without really understanding the underlying businesses.
It's a cautionary tale about the dangers of following the crowd without doing your own due diligence.
Right.
And speaking of trends in the investment world,
Yeah.
we can't forget about the rise of index funds and ETFs.
Yes. The set it and forget it approach to investing index funds and ETFs have become incredibly popular in recent years, offering investors a simple way to track the market without having to pick individual stocks.
Exactly. These passive investment options offer several advantages, including low costs,
Yeah.
which can significantly boost returns over time,
Right.
and diversification, spreading your investment across a basket of stocks to reduce risk associated with any single company.
While these passive options sound great, it's important to remember that you're essentially surrendering control to the market. What happens if the market takes a prolonged downturn? Are you just stuck riding the wave down?
That's an important consideration.
Yeah. Yeah.
While index funds and ETFs can be powerful tools,
Right.
they're not without risks.
Right.
You need to choose an index that aligns with your investment goals and risk tolerance.
Okay.
And you need to be prepared for the inevitable ups and downs of the market,
Right.
even if you're passively invested.
That makes sense. It's like choosing the right boat for your journey. You need one that's sturdy enough to handle the storms, but also one that's headed in the direction you want to go.
That's a great analogy.
Thanks.
And within the world of index funds, we're seeing the increasing popularity of fundamentally weighted index funds as an alternative to the traditional market cap weighted indexes.
I'm curious about these fundamentally weighted index funds. How are they different from the more traditional index funds?
Traditional index funds, like those tracking the S&P 500,
Yeah.
are market cap weighted,
Okay.
meaning that the larger a company's market value, the more influence it has on the index's performance.
Right.
Fundamentally weighted index funds, on the other hand, weight companies based on factors like dividends, earnings, or sales,
Interesting.
rather than just their size.
So it's like rethinking the recipe for the index, giving more weight to companies that are fundamentally strong, regardless of their market cap. Does that mean they're aiming to capture some of those same drivers of outperformance that we discussed earlier with factor investing?
You're exactly right. Proponents of fundamentally weighted indexes argue that they can potentially offer investors several advantages,
Okay.
including higher returns, lower risk, and a greater emphasis on value.
That's fascinating. It sounds like they're attempting to marry the benefits of passive investing with the insights of factor investing.
That's a great way to put it as we wrap up this section of our deep dive.
Okay.
It's clear that the world of long-term stock investing is a complex and ever-evolving landscape full of possibilities and potential pitfalls.
Absolutely. From understanding the fundamentals of market returns to navigating volatility and exploring different investment strategies, we've covered a lot of ground.
We have.
What are some key insights we can take away from all of this? It feels like we've been on quite the journey through the stock market,
Yeah.
covering everything from historical crashes to the psychology of investing.
Yeah, it's been quite a deep dive indeed.
It has.
But even with all this information,
Right.
it can still feel overwhelming to know where to start as an investor.
That's true. So what are some key takeaways our listeners can use to guide their own investment journey?
Sure.
What are the essentials to keep in mind?
Well, first and foremost, remember that time is your greatest ally in the stock market.
Okay.
The longer your investment horizon, the more likely you are to benefit from the power of compounding and to ride out those inevitable market fluctuations.
It's like planting a tree.
Right.
You don't expect to see a mighty oak overnight. It takes time, patience, and consistent nurturing for it to truly flourish.
What a great analogy.
Thanks.
Patience is indeed a virtue in the stock market.
Yeah.
It's about staying focused on the long game and not getting spooked by daily headlines or short-term market noise.
So resist the urge to panic sell when the market dips.
Right.
And remember that over time, the market has historically trended upwards.
Exactly. And here's another essential takeaway.
Okay.
Diversification is crucial.
Okay.
Don't put all your eggs in one basket.
Right.
Spread your investments across different asset classes, industries, and geographic regions to reduce your overall risk.
This is like building a sturdy bridge with multiple supports.
Yeah.
If one support weakens, the others can still hold the structure up.
Precisely, diversification helps to create a more resilient portfolio that can withstand market shocks.
Right.
And finally, never stop learning.
Okay.
The market is constantly evolving, so staying informed and adapting your strategy as needed is essential for long-term success.
So even if you're a seasoned investor,
Yeah.
there's always something new to discover.
Right.
It's about staying curious, asking questions, and being open to new information.
Exactly. Don't be afraid to challenge your assumptions, explore different perspectives, and refine your approach as you gain experience and knowledge.
Speaking of learning, I feel like this deep dive has been a crash course in long-term stock investing,
It has.
covering everything from the fundamentals to the nuances of different strategies.
Yeah, it has been quite a journey, hasn't it?
It has.
But as we've learned, the learning never really ends in the stock market.
So where do we go from here? What's the next step for our listeners who are eager to apply these insights?
Well, as we wrap up this episode,
Yeah.
let's leave our listeners with a thought-provoking question to ponder. Given the changing dynamics of the market, what factors do you think will drive stock returns in the future? What trends are you watching?
Okay.
What innovations are capturing your attention?
That's a great question to spark some reflection.
Yeah.
We've explored historical patterns and current trends,
Right.
but the future of the market is ultimately shaped by countless variables, some predictable and some not.
And each investor has their own unique perspective and set of circumstances. The key is to approach the market with a thoughtful and informed mindset, always seeking to learn and adapt.
So to our listeners, we encourage you to continue exploring, keep learning, and keep investing wisely.
And remember, as we always say on others, the deep dive knowledge is power, especially in the stock market.